First, we're going to learn about dividend, what dividend is. So this says here, dividend is explained here. A dividend is a distribution of part of the earnings of the company to its equity shareholders. So which meaning here is that a portion of their earnings will be actually distributed among all the existing shareholders according to the shares they purchase. If they purchase preference share, their percentage must have been mentioned. If they purchase equity share or ordinary shares, their shares must be that will be different way to calculate it. Now, this is the payment of cash dividends. Okay, how does the company make the payment? The payment can be in cash, it can be with some other way. Not necessarily all the time, must have to be in cash in hand or cash payment. No, dividend can be paid as some other form as well. Okay. The company's business decisions involve, okay. And one of the decision the directors of the company will make, how much dividend to be paid, or whether the dividend is even necessary to pay. We'll talk about it. So in practice, while making the dividend payout decision, how much dividend they are going to make payment to the shareholders, the company needs to consider whether dividend decision is related to other financial decisions. They have to check what other financial obligations they have, what other financial opportunities they have. They will look at those things first. And second point, they look at the effect of changing dividends and whether to adopt a dividend reinvestment plan. They will check two things in here on the second part. They will check effect of changing dividend. If they change the dividend, okay. If they change the dividend, how it's gonna affect. Another thing they will check is whether to adopt a dividend investment plan. Dividend investment plan meaning that dividend will be reinvested. Okay. Then talk in Australia, how do they actually make the dividends? How the dividend payments pattern is. So final dividend paid after the end of accounting year. That's the final dividend. But before the final dividend, there is another type of dividend. It's the interim dividend. So in Australia, dividends are usually paid twice a year. One at the end of the year, final dividend, and before that, they have another one, which is called interim dividend. So two dividends there. Dividends are corporate earnings that companies pay to their shareholders. Okay. Whether the company will pass the earnings to the shareholders or not depends on the current situation of the company. What the company's situation is. Company is doing very well. They do not need much cash. Cash will be idle sitting in the business. They will decide to actually give it to the shareholders. So when they give dividends to shareholders, they might go in 4 different ways. One of them, they might increase the dividend amount. They might decrease it. They might keep it as it is, remain constant or same. And another one is, they will decide not to pay any dividend at all. So it depends on the company's situation and the company's financial obligations too. Okay. So in general, people always like to see that there's some dividend is being paid. In general, most of the shareholders are happy if they receive dividend. Okay, some shareholders with higher income prefer shares instead of dividend payment. Okay, for tax. So some of them they don't want dividend too. There are some investors who do not like to have dividends, cash dividends. They prefer some other share to be issued instead of issuing the dividends. All right. Next one. When a company do not pay dividend, when they decide not to pay dividend, As I said before, when the company will see that they have a good prospect, they have a good future, and they need money to reach to their future, they have a good prospect. Even a company who is growing, okay, they will not be interested to pay any dividends. They want to roll the money within the business. So a growing company with further growth prospect usually do not pay dividends. Okay. All right, so when understanding the dividends, we need to understand another thing in here, which is called ex-dividend date. This is very interesting part. Okay. So a couple of things. When the company decides to issue a dividend, okay, the day they declare, date the dividend is declared by the firm directors. The day dividend is declared by the firm directors. On this day, what happens? The directors will decide that we are going to pay this much dividend. Okay. How much dividend is that? Well, they decide 5%, 10%, whatever they decide from the earnings. Okay, 10% of their earnings. Don't think that 10% are each share. No, it's not like this. Okay. Date of record. On this date, what happens? Only listed shareholders on the register or shareholders on the date of record, okay, are entitled to receive a declared dividend. So on the day of record means from that day, they are actually allowed to receive the money. And payment date is the date when they may start making the payment. The actual date of payment of the dividend is usually several weeks after the date of record. On the payment day, the total amount of dividend paid is debited from the dividend payable account and in the cash account. So what happens in this case? So we know 3 dates. Date, the dividend is declared by the firm directors. Date of record. Okay, on this day, shareholders are entitled to receive their money. Payment date, then the money is transferred from cash account to the dividend payable accounts. And this one, ex-dividend date, this one is a date. This is 2 days before the date of record. So if someone purchases a share after the ex-dividend date, they will not receive any benefit because dividend already been declared. So you know how much profit they're getting. You cannot do that. So, and here they showed you the journal account. Sorry, ledger account in here. You can see that. So on the day of the declaration date, okay, this before the declaration date, here before declaration. Look at there, before is important. Before declaration, and this is after declaration. Before declaration, the balance of the book was like this. They had cash of $300,000 cash. Dividend, there was no dividend payable. There was no dividend obligation or liabilities. Earnings, retained earnings was 500,000. This is the company situation. So all dividend payable was paid and everything was up to date. Then they declared that we are going to issue a dividend. How much dividend they're gonna issue? I think they said here something. Okay. So it was actually $60,000. They decided to pay dividends. Okay. And what happened? Look, money will be transferred from retained earnings to the dividend. Retained earnings reduced, dividend payable increase. Okay. After this, then when they start making the payment, after the payment of the dividend payment was made, then now they know that they have a dividend liability here. How much? 660,000. This money will be paid from cash account. So cash account has been reduced, and also dividend payable account has been paid. Okay, so this is your journal entries in here. How did they get the 60,000? I think it's very straightforward in here. Okay, the dividend of $1 per share to be paid on 19th of July with the date of record on Friday, 21st of June. Okay. Okay, 60,000 shares and each share will get $1. That's how they got it. Now, second topic we're going to discuss is about dividend reinvestment plan. On this plan, we'll discuss about how the dividend will be reinvested. Very straightforward. Under this plan, shareholders can choose to receive newly issued shares instead of declared cash dividends, usually at a favorable price compared to the current market price. So let's say current market price of share is $20. Okay. So this is current, I write down here, current market price is $20 of a share. $20. So you have been offered a dividend of, let's say, $35. Okay. So you have the option. Either you can take a $35 dividend or you can ask for 2 new shares. At what price? At market price. But they will give you a discount because you're existing shareholder and you have chosen to reinvest within the business. So they will sell you at a lower price. Okay. Then 2 will be, market price is 40, but they will sell it to you at 35, like this. Okay. So these are now popular in Australia, and they also reduces your issue cost, flotation cost, and also you get a imputation tax credit. Okay. Yes. Another one we're going to talk here now. Forms of dividend policies. What are different types of policies you have? Okay. So price of a share, we know this one. Price of a share is equal to, you can say this one. Price of a share is equal to this. Okay. So you can say at the same time that you can see here. Or you can say like this, comma, the dividend is equal to P0 multiplied by RS minus G divided by one plus G. So this is the situation you can say. And you see here from the first equation, from the first part here, if D increases, dividend increases, price of share will increase too. Okay. If D increases, your price of share will be also increasing. Okay, so and this is normal our constant growth model. And okay, the various types of dividend policy have been identified. One of them called residual dividend policy. In residual dividend policy, in this type, the entity, the directors will decide directors will decide to distribute some dividend within the shareholders when they do not have any other options to do with the money. Okay, when you will have no other, then they will have no other option to do anything with the money. They say the residual dividend policy is followed if a firm pays out as dividends any profit. Okay, any profit that management believes cannot be reinvested profitably. When they say they do not have any other better option, they will distribute their dividend. This is the residual dividend policy. Then another one in here, constant payout ratio policy. Okay, so every year they give them like 10% of the total income as dividend. Okay, let's say the business made a $10 million profit, so 1 million will be going as a dividend to distribute among how many shareholders they have. Constant payout. So every year you maintain the constant percentage of earnings. Regular dividend policy is another one. And this one, this says, involves payment of a fixed dollar amount of dividend each period. Some portion of fixed amount will be paid. Okay, at least until increased earnings can be reliably predicted. So until they know that the earnings, increased earning, extra earnings, till that time, what they're gonna do, they will give them some cash amount as dividend. Low, regular, and extra dividend policy. Okay. This involves payment of a relatively low dividend each period that is augmented by extra dividend if higher temporary earnings are experienced. So if they have a higher experience, higher temporary earnings will be coming to the business. Okay, then they will be making a low but regular payment of this dividend. This is interesting one. Share dividend, they will give you bonus share. Okay, they give you some bonus share. Like a share dividend involves the issue of new shares to shareholders instead of dividends. They don't give you a dividend, but they give you shares. In theory, a share dividend should not result in a change in the value of shares held by the shareholder, but merely a transfer from retained earnings to the share capital. They are not actually physically giving you the money. Money stays within the business, but it will be just transferring from retained earnings to the share capital. Like they showed you the one example in here. Suppose this is the situation of the business. Ordinary share was actually 2.5 million. And retained earnings is $600,000. $600,000 is retained earnings. Total shareholders' equity is this much, $3.1 million. So now they got 150. Company declares 5% share dividend. Okay. One bonus ordinary shares for every 20 share sales. So all those people who has 20 shares, okay, they'll be given one share. And the current market price of the shares is $60. The resulting amount retained earnings to be transferred to ordinary shareholders will be 150. Okay. So they have 50,000 shares, 50,000 shareholders. Okay. They'll be given 5% share dividend. Okay. And it is $60 of each share, so 150 1,000 they need. So now they will be transferring 150 from the retained earnings to the share capital. That's it. Retained earnings will be reduced. 450 share capital will be increased. That's it. The total share equity remains the same. Dividend is already paid. Okay, share capital has increased. Okay. Another share split. 2-for-1. It means like if you have one share, they'll give you two. Share split. A share split results in a greater number of shares being held by each existing shareholders, but in theory, no change in the value of the share held need occur. For example, a 2-for-1 share split results in each shareholder receiving 2 new shares for each existing share. Okay. So if you have 1 share, you'll receive 2 shares. In this case, the recorded par value of shares would be halved. The number of shares on issue would be doubled. So share price will be actually going down. The par value of the share will be going down. After a share split, total market value of the firm share could be unchanged, although sometimes it may increase if the share split is considered to signal good news. So since they're actually dividing the par values, okay, as a result, what happens? Your share issued share price, issued share value remains the same. Share buyback is another option. With share buyback, company actually, when mainly management, when they feel that their share is actually being traded in the market at a very lower price, undervalued, they will take the share out of the market. That's share buyback. They buy the share out of the market. Okay. Share buyback can be viewed as an alternative way of paying cash dividends. So yeah, so they're going and taking the share out of the people's. Okay. All right. Dividend policy is relevant. We'll talk this one now. Miller and Modigliani, MM. And another policy we have. Okay, dividend relevance. Retention tax system. Yes. Okay. Miller and Modigliani theory, what they say here is that this group believes that changing dividend policy is not actually going to affect the share price. Okay, that's what they mean here. So Franco Modigliani and Martin Miller, 1961, suggested that the value of the company depends on its earnings only, not the dividend policy, very strongly. It says that value of the company depends on the earnings only, not the dividend policy. Dividends and capital gains are equivalent when an investor considers returns on investment. Therefore, their question is whether you receive the dividend or your share price goes up, the capital gain. Ultimately, you will be calculating return on investment. Okay. If the company performs well, the share prices will increase, and the investors are capable enough of making their own cash flows from the stock depending on their need for the cash. If the company is doing very well, share price will increase. So who need to make some money, they can make the money when the share price goes up. If the investor needs more money than the dividend he received, he can always sell a part of his investment to make up the differences. So yeah, so if someone needs a hard cash right now, they can sell their shares anytime. So it's including actually secondary market too. Likewise, if an investor has no present cash requirement, he can always reinvest the received dividends in the stock. Thus, the Modigliani and Miller theory firmly states that the dividend policy of a company has no influence on the investment decisions of the investors. So he believes that investors don't think like this. Okay, that's what his point. So he thinks that investors don't think like this. Okay, so the assumptions when he made this model, he made some assumptions, like the 4 assumptions they have in here. Okay, first assumption is perfect capital market. So from his point of view, capital market is perfect, but which is actually not true. And on his theory, he did not actually consider taxation. Okay, tax has not been considered in here. And fixed investment policies, the company does not change its existing investment policy. So company investment policy also change. That also has not been considered. And no risk of uncertainty. So in his model, he will consider there are some risks involved in here. Okay. Now, so because they have some assumptions, that there's 1, 2, 3, 4 assumptions they're based on. So because of these 4 assumptions, there are some criticism too. Okay. There are some criticism as well. So like, as I said, that the first point is capital market, perfect capital market. This part is fine. We have no problem with what he's saying, but when he's saying these things, it's actually theoretically possible, but actually going practical life, it may not be possible. Perfect capital market doesn't exist. Okay, perfect capital market do not exist. Okay. Taxes are there, tax needs to be paid. So when you make a profit on dividend, you have to pay taxes, that's taxable income. Okay. Then those things about risk, fixed income policies. Okay. According to the theory, there is no difference between internal and external financing. Internal financing is good. External financing, you have to pay something in return. If you take from bank, if you issue shares, whatever it is. If you can do the financing from within your retained earnings, that's the best. Okay. The theory believes that the shareholders' wealth is not affected by the dividends. However, there are transaction costs associated with the selling of shares to make cash inflows. So when you do the dividend, you do not have to pay any transaction cost. But when you're going to sell the shares, there are some other costs involved. Transaction cost will be involved. If you have made some capital gain, then you have to pay some taxes as well involved. Okay. So these things he did not consider. And also he did not consider about uncertainty, risk involvement. Okay. So this is an example in here. The example is about based on Miller and Modigliani's theories. It says, suppose that in a given year, a large company's capital budget requires 50 million of equity financing and that earning of 70 million are expected. So they need $50 million, but the earnings will be 70 million. So they need this $50 million. Okay. Then assume the Miller and Modigliani assumptions hold and that the firm has no retained earnings from previous period. So how much can the company pay out in dividends without having to issue new shares? Okay. So the company can issue $20 million of dividend. How they can issue this 20 million? Because they will have $20 million profit. So if they issue the whole amount of money, there is no retained earnings. So yes, second point is, by how much will existing shareholders' wealth increase if maximum amount of dividend is paid out without having to issue new capital? So they have issued the dividend of 20 plus the capital gain of 50, $70 million. Okay. But hence the capital gain represents an increase in the value of the firm's assets, the same amount as the internal equity financing. Okay. By how much will existing shareholders' wealth increase if the earnings are paid out as dividend and the equity financing needed is made by issuing new shares? Again, the same thing. In this case, there is no capital gain for the existing shareholders, but they simply receive $70 million as dividend. The value of the firm's asset financed by equity gain increased by 50 million, but this represents wealth of new shareholders. Similarly, if the firm pays $40 million in dividend, retains 30 million and raises 20 million from a new share issue, the wealth of all shareholders will again increase by 70. Okay. Okay, so residual, okay. So they mean that for Miller and Modigliani, a residual dividend policy is good for them. Okay. If you do not have any other things to do with the money, like in this case as well, if the retained earnings is full retained earnings is paid to the shareholders as dividend, so as a result, what happens is that they're not left with any money for any future project. That's the problem. So this Modigliani's theory is possible if you do not have any other option but to keep the money lying within the business, then you can use Modigliani's theories. Okay, let's move on. Existence of dividend clientele. Okay, another problem is that. So yes, I understand. We understand that dividend policy is not an issue, but there are some investors there who is looking for dividends only. Okay, there are some investors there who is going to invest only because they want to see some dividend. The companies may tend to attract investors or clienteles that prefer their particular dividend policies. For example, higher dividends to investors requiring higher current income. However, provided supply and demand for particular dividend policies are equal, dividend policy need not affect share values insofar as investors simply get what they expect. So look, it's not necessarily only the company's performance is everything, no. In secondary market, when you go in secondary market, the demand for the specific share or demand for a company's specific dividend policy will also make some changes, make some effect on your share price. Okay. For the last project, we'll talk about dividend relevance theory. So this group believe that dividend is important, dividend is related, is relevant. Says the dividend irrelevance result will not hold if any of the specific assumptions are not satisfied. So dividend irrelevance theories, which is Miller Modigliani's theory, is not very valid. Okay. It will not be valid if the assumptions are not correct. But most of the assumptions are not correct actually. So now they have different types of theories about dividends. First one they want to talk about, first approach is bird in the hand argument. Okay. So why they think dividend is important? Bird in the hand argument in the sense this way. Whatever you have within your hand, grab that first. Share price might go up or down. It will take time. Share price will go up eventually, but it will take time. But dividend is actually dividend is the amount of money that you are actually getting it spot on. Okay, so what you're getting right now in your hand, that's a dividend. Every year or after every 6 months, they're offering you some dividends. Okay. All right. So they have this is a diagram they're trying to show you here. One is with share price. You can hear the share price and dividend payout ratio. Another one here is on the other side, this is cost of equity. This is cost of equity, and this one is share price, two different. Okay. So you have your cost of equity, other side is dividend payout ratio. So now look, when your dividend payout ratio increases, okay, dividend payout ratio increases, it means how much dividend you are paying, it increases. What happens? Share price will be increasing. Okay. But Miller-Modigliani relevance theory, they say no, share price will remain the same. Since the demand for the share, demand for the share price, demand for the share is increasing, the share price is increasing. As a result, their tax preferences will decrease. Tax preferences, tax shield will be decreasing. Okay. The share price will increase. Share price increases, this means that your cost of capital decrease, cost of equity will be decreasing. Okay, so here they showed you here cost of capital side. From cost of capital, they show that dividend payout ratio increases. As a result, your dividend increasing, the dividend will be decreasing because more shareholders will be coming up. One thing. Second problem is this: the cost of capital will increase. Okay, for tax preferences, we do not have much tax advantage in there. And this will be much more clear to you how the tax advantage can be gained. So this comes from here, dividend imputation tax credit system. So what it does is that when the company pays you dividend, they already pay some taxes off. Dividend is an income, and this is taxable income. So when a company will issue you a dividend, give you a dividend, you will have to pay tax on it. Okay, you will have to pay tax on it. And another thing will be this: when the company will issue you some dividend, they have already paid some tax of it. If the 100%, they call it frank dividend. Frank dividend means tax is already paid. Okay, the corporation tax rate, at a corporation tax rate, tax is already paid. So this says here, so here how much tax credit will be there, tax benefit you will receive. This is the formula. Okay. Cash dividend multiplied by tax rate, the of course corporate tax rate, TR, divided by 1 minus TR, 1 minus tax rate into franking ratio. Franking ratio means what percentage of your share, what percentage of tax has been paid. Okay. So if it is fully franked, it means 100% tax has been paid. If they say 70%, then 70% has been paid. 70% of a dividend has been paid as tax. Okay. I think they have one question in here for this. Okay, they have in here one example. Let's solve this problem. Suppose a company pays out fully franked dividend of $70. I need to put some charger. Okay. Suppose a company pays out fully franked dividend of $70 each to investors with marginal tax rate of 19%. Okay, so there are three different types of investors. One investor, his marginal tax rate is 19%. Marginal tax rate, individual income tax rate. Okay, marginal tax rate means individual income tax rate. 32.5% and 45%. So it depends on their income level. So the first person is marginal tax 19% tax bracket. Second person 32.5% tax bracket. And the third person is 45% tax bracket. That's personal income tax. The statutory company tax rate is 30%. Okay. How much tax will each investor pay on his or her franked dividend? How much they will have to pay. So now look at here. Each of them has been paid $70 fully franked. Right? This is fully franked, isn't it? So fully franked dividend of $70. Okay. So it means they have paid 70% of the tax. Sorry, 30% corporation tax has been paid. After paying this tax, $70 has been given to them. Okay. So there, how much was the total tax? The total tax was, that's how they calculate these things. So you can say here, gross dividend. So how much total dividend they have received? Okay. Equal to gross dividend will be equal to will be 70 divided by 0.07, 7%. 0.70 into 100 multiplied by 100 will be equal to 100. That's the amount they will receive. Okay. So they will receive actually $100 in here. So the total sum up will be $100. So I should actually say it 100%. Yeah, that will be a gross dividend. So how much tax was paid? franked, how much is equal to the difference between these two, $30. So they received gross dividend was $100 and net dividend received was how much? 70. $30 is their tax paid. Okay. So they will be able to receive $30. So the formula is in here. You can go like this way that I'm doing by using common sense, or you can follow this formula. It's straightforward. Okay. Formula is this. Yes. That's what you can say. This is $30. That's how they got it. Dividend into tax rate divided by 1 minus tax rate. I also did exactly the same thing. Dividend divided by 1 minus tax rate into, because I did not calculate the tax franc. So now I'm going to actually multiply with 30%. And you can see it 30%. So tax franc or how much? It will be 100 multiplied by 100 multiplied by 30%. 30% equal to $30. So that's my tax franc. How did you do that? Same thing. This formula. Okay. All right. So for 3 different of them, you have to find out how much tax has been franked. $30 has been tax franked. For the first person, he will receive a tax credit of $11. Why? Because his tax rate is actually $19. Okay. So how much tax is supposed to pay? That person is supposed to pay $19 tax, but the company paid $30 tax. So $11 will be refunded back to this first investor. For second investor, no. Second investor is 32.5% his tax bracket. So since $100 is the gross, so tax will be dividend tax will be actually calculated on the gross dividend. Then they will check how much tax has been franked or paid by the company, and then they will calculate the rest amount. So for this first person, you see 90% marginal tax rate. So his tax will be $19, but the company already paid $30 tax, so he'll be receiving $11. For the second person, 32% is the tax rate. So his gross tax will be 32.50, but the company already paid $30. So this person needs to pay extra $2.50 to the tax office. Final person, his tax is 45% his tax, because $100 dividend. So $45 will be his tax, and company already franked $30, paid $30 tax has been paid. So more $15 this investor needs to pay to the tax office. That's it. And they have done here some example of the same thing. Okay, you can try one of these example. Okay. So try this one. Okay, this one, they say that suppose a company pays out fully franked dividend of $120 each to investors. So $120 is their dividend payment, frank dividend, right? Okay, so let's find it out.
I'm sorry, I think your connection is having a problem. I cannot see your screen.
Are you going to see my screen?
Yeah, it's fully black.
You okay now?
Oh, no.
Give me a second. Name, share screen, share. Is it okay now?
No.
It's still not okay. Is it okay now?
Oh, yes, I can see it now. Thank you.
Okay, yeah, what happens is this June thing drops off, line drops.
Oh,
That time you guys lose me.
yeah.
That's fine. Well, let's move on. So here, the company has paid $120 after paying 30%. The company tax rate is 30%. You see that? Company tax rate is 30%. And marginal tax rate, this means personal investor. Look at this. Marginal tax rate is 45. So marginal tax rate means individual tax rate. Okay. And that the 30% is company's tax rate. So the question is, how much tax will each investor pay on his or her franked dividend? How much tax they have to pay? It's very straightforward. We have to find out his gross amount, how much dividend has been paid, okay, or how much franking credit has been provided. You can see 120 has been paid. So how much franking credit was there? Franking credit means how much money has been paid at tax. Franking credit will be equal to dividend multiplied by tax rate, which is 30%, 0.3, divided by 1 minus tax rate. Right? 1 minus tax rate is 70%. Right? 1 minus tax rate is 0.3, which is actually 70%. So how much in total you get from here? We equal to 120 into 0.3 divided by 1. They did it already here. 51.42. $51.42 is your, this much tax has been paid. Okay. So how much will be your gross dividend? So 51.42 plus 120. So your gross dividend is equal to 120 plus 51.42 is equal to 171.42. That's your gross dividend. Okay. So how much is tax on your gross dividend? So you say here, tax payable how much? 171.42. 171.42 multiplied by, their marginal tax is 45%. So it will be 45, so it will be 0.45 is equal to your 77.14. That's not tax payable. How much tax has been paid by the company? 51.42. Okay. Now you write tax liability will be equal to 77.14 minus corporation already paid 51.42. That's it, which is 25.7. This much tax you need to pay to it here. That's it done. It's not that tough. Yes, so that's the whole calculation. Okay. All right, and this one just calculate the tax credit, easy. Dividend multiplied by this franking ratio. That's it done. Okay, in this case, we did not do franking credit because it is always 100%. Okay, or multiplied by 100%. That's why we did not do it. Okay, if you want, you can do it actually. Multiplied by franking ratio is 1. That's it. All right, now next question is, do dividend matters? To some people, yes. To some people, no. There are people who actually wants to see dividend stream as their income. There are people who wants to see that the dividend stream is their income. Okay. Other group, they don't. So the people who actually believe that yes, dividend is an income for them, and they calculate the price of the share as a cash flow, dividend inflow in the future. Okay. That's it. Now let's try with our other problems. Yeah. Okay. So we have, let me do our attendance. Okay, guys, I'm not going to share this screen because I should not share any information that can identify someone with the name and ID number. So I'm not allowed to do that. I recently learned these things newly. Okay, so I'm going to call your name, so you have to respond to me. Okay, you can respond vocally or you can send the text. That will be fine. Okay, let's do it. Okay, is Daniel Baran here?
Yes, I'm here. Yep.
Thank you very much, Daniel. Hyung Ham Cho. Hyung Ham Cho. No. Thomas Condon. Thomas. No. Li Pu Tao Du. Lidu.
Yeah.
Thank you very much, Li. Gurlin Kaur. Gurlin Kaur. No. Priscilla.
Here.
Thank you, Priscilla. Bahi Imam. No. Welwin Kuriakoze. Welwin Kuriakoze. No. Ihan Lee.
Yes, sir.
Thank you. Venkata Sai Posa. Venkata. No. Ananya Rizal.
Hello.
Yes.
Hello. Hello, sir. Good in here.
Gurlin here.
Yes.
Okay.
My microphone was not working.
Okay, that's fine, Gurlin. Okay, who is next? Ananya Rizal there? Ananya Rizal? No. Then this is Timothy Smith. Timothy? Tim? No. Junkai Wang?
Yeah.
Thank you, Junkai. Tuhan Bak Jung? Tuhan Bak? No. Then Yoheng Lin?
Yep. Yes, I'm here.
Thank you very much, Yoheng Lin. Li Hui Fei Dong? Li Hui Fei Dong? No. Jacob Labde?
Yes, sir.
Thank you very much, Jacob. Weijian Jiang? Weijian Jiang? No. I think that's all. Are you guys doing the feedback thing? If you haven't done these things, can you guys please do these things? The teacher's feedback thing?
Yeah, sure.
Thank you. All right, I'll go back now to the sharing mode again. Oh, someone texted me. Okay, Timothy and Ihan Lee. Okay. Timothy. Timothy is here. And Johan Lee already done, yes. Johan Lee, yes. Okay. Can you guys see the screen now?
Yes.
Okay, good. All right. Now you're gonna solve these questions. What is leasing? Leasing is one of the financing technique, strategy, or trick, okay, at which the lessor receives some money as a rent and the lessee will be paying the money as a rent. For what? For capital budgeting, to finance an asset. There are two different types of lease, operating lease and finance lease. In operating lease, it is for shorter term, but for finance lease is for longer term. Operating lease is, finance lease is mainly, it is most of the lifetime of the machinery is covered by the finance lease. For operating lease, it's not, it's very short time. Okay. And financing lease is non-cancelable, but operating lease is cancelable. A private radiology clinic wishes to expand its facilities with an additional ultrasound scanner. The scanner can be leased, a finance lease, or purchased. The purchase price would be $150,000 and there would be no installation cost. The firm running the clinic is in the 30% tax bracket. And its before tax cost of debt is 10%. Okay. If they go for leasing, the lease term would be 3 years and would require annual lease payments of $54,000 with the lease payment made at the beginning of the year. Okay. The lessor would pay all maintenance costs, but insurance and other costs would be borne by the lessee. Okay, they have these three conditions, and the lease will have the opportunity to purchase the item at $25,000 after this. And if they go for purchasing, what options they have under purchase? This is under lease. It will cost them $150,000 that can be borrowed at 10% per annum. Loan need to be paid in 3 equal annual installments of this much each, which is the first payment made at the end of 12 months. So lease payment at the beginning of the month, but is only the end of the month. Okay. Purchase price of the machine would be fully depreciated using the prime cost method, 3 years. The firm would pay $2,000 per annum for a service contract which covers all the maintenance costs. Insurance and other costs would be borne by the firm. Okay, this is the situation now. What do you have to do? So is that calculate the after-tax cash outflow associated with the leasing of the ultrasound scanner. Okay, so we calculate the after-tax cash outflow. One question. And calculate the after-tax cash outflow associated with the purchasing of scanners. Okay, we have to do both of them. For leasing and for purchasing, both of them we have to calculate after-tax cash outflows. Okay. And later, based on this A and B, we have to answer which one they should do. Should they go for buy or they should go for leasing? Okay, we are going to solve this problem now. All right. I'll do one by one. So let's go number 1, A. first we'll do about the leasing. Okay, how much they need to pay. Okay, so let's do our payment chart. Year, lease payment, how much tax shield they have, lease termination payment, and finally here after tax cash outflow. Okay. So we have year 0, 1, 2, 3. Okay. How much is lease payment? Lease payment is our $54,000 every year. We have to pay the beginning of the year. Okay. And we will have a tax shield. How much will be tax shield? 30% of $54,000. So our tax shield will be equal to 30% of 54. Okay, which will be equal to okay. Lease termination pay. This is after 3 years we can pay $25,000 and buy the machine. Lease termination is not outflow. Lease actually is actually your benefit inflows. Okay. All right, lease termination payment is there. So how much will be after tax payment? So first year it will be 54,000. Second year will be 54,000 minus 16,200. It will be 37,800. This year also remain the same, 37,800. And this year will be minus 16,000 plus 25,000. It will be different. It will be 8,800. Okay. So this one is here, 16,200. All right. That's it. Next, you have to calculate after tax cost of debt. So how much our cost after tax cost of debt will be equal to how much it will be? 0.1 divided by the said here minus 0.3. I'm going to explain it. Give me a minute. Into 7%. Okay. What is the rule? How did you calculate these things? Okay. Look, the side here, they go out in here. Okay. Before tax, the farm clearly, okay, tax background is before tax cost of debt is 10%. So what we have done is this, we have taken before tax cost of debt is 10% multiplied by 1 minus tax rate, 70%. Okay, 7% will be the tax rate. Okay. Now you need to calculate the present value. Present value is equal to $54,000 for the first year, year 0. Okay. This one, so we're gonna present value of this plus now we're gonna add up our annuity values for this 2 year 37 and 8, 37, 8. We're gonna do the annuity table in here. 37,800 multiplied by 1 minus bracket 1 plus 0.07 bracket close and d1 to the power minus 2 close divided by 0.77%. Okay, so first 54,000 is for the current year. You don't have to calculate present value for the present time. Okay, this is for the next 2 years, 1 and 2. Last one you could not add it on annuity because it's not the same figure. So 8,800 we have to calculate 8,800 as present value formula. Okay. All right. Plus we have to now do our present value formula again. Okay. What the formula is? Let's go here. It will be 8,800 divided by first bracket 1 plus 0.07 bracket close and to the power and n is here to the years. Here also the same. The present, if you talk about present value analysis, these one will also remain the same. I will show you here. Also remain the same. This is just third year, but these one will be just this will be year 0. Anything to the power 0 is equal to 1. That's how I get 54 actually, nothing else. Okay, this is our present value analysis, and the value, all of them will be equal to 129,526.51. So this is the present value of the money. All is outgoing. Okay. This is the present value. Now you're going to do the second part. Calculate the after-tax outflows. Okay. Calculate the after-tax outflows associated with purchasing the scanner. Okay. Now we do the scanner part. Okay. First, we're going to do about the loan amortization table. First, we'll do here loan amortization table. Okay. Here, outstanding amount, interest rate, payment made, and principal amount. This is the amortization table. Okay, for year 1, 2, 3 years. They said on the first, they're gonna take $150,000 of loan. Okay. And how much will be interest? They said 10% interest rate is mentioned there. Okay, it mentioned there to be 10% interest rate. Or did it mention? Yeah, before tax interest rate is 10%. Okay, 10% interest rate. Interest is 15,000. And they said that they will make a payment, 3 payment of 60,317.22. These 3 payment they will make. Payment of this amount for this. That's what they're gonna pay. How much will be interest in here? How much will be left? So 60,000 payment, 60,000 minus interest paid. Okay, so 150 minus 60 minus equal to the amount is principal amount paid. In this case, this one is 45,317.22. Okay, that's what the amount is paid. And now you have to deduct this principal amount that has already been paid from 150. The rest of the amount will be actually coming in here, so it should be 104,682.78. And your interest rate will be here 10,468.38. Okay, and here the amount will be how much? So your tax interest is 10,000. You paid 60,000. Rest of the amount is your principal amount paid. Okay, how much will be that? 49,848.94. And last year, so after out of 104,682.78, you did subtract this 49. The rest of the amount is your payment. And your interest will be here 5,483.38. That will be your, and the rest of the amount will be paid. The whole amount will be paid in here. That's your loan amortization table. So this is the amount. That's how you pay. So we do this loan amortization to find out our interest payment amount. For this one, we need to do these things. Okay. Now we're gonna get our cash outflow. We're gonna find out how much is our cash outflow. Okay. Cash outflow table. Let's write it down. This is our year 1. Year 3. Our loan payment will be how much? This one. That will be our loan payment every year. Then we have depreciation. Depreciation will be how much? They said it will be vanished in 3 years' time. The purchase price of the machine will be fully depreciated using the prime cost registered then method in 3 years' time. So 150,000 divided by 3, every year it will be 50,000. Okay, that's why you subtract your. And your interest payment, now you use your interest. Now you use this one. First year is 15,000, second year is 10,468, and third year is 5,483. Okay. Then they have maintenance. They have maintenance payment, which is $2,000 every year. Okay. This is their total tax deduction. So you write down here. Tax deduction will be how much? You have to add up these three. Okay. So this is 50, 60, 67,000. 67,000. And next year it will be 62,468.28. Third year it will be 57,483.28. That's tax deductions. How much will be tax shield? The tax shield will be 30% of the deduction. Tax shield will be 30% of tax deductions in here. Okay, 57,000, one third of these things. 100. 18,740.48. Just 30% of the tax deductible. So 30%. Okay, so about 30% of this figure. So how much will be your after tax outflow? What is the formula to calculate after tax outflow? We'll be calculating here 60,000. Okay. Plus maintenance expense 2,000. That's total payment you're gonna make. Okay, and you will be adding up your this figure minus subtract this figure. Okay, it will be let me write it down in here. This is 1. I should say A, B, C, D, not 1. A, B, C, D. Tax deduction, this one is actually A, not A, sorry, B plus C plus D. That's the tax deduction. That's the tax deductions. Okay, tax shield. This one, let's say this one is P. Okay, so this we can write down here that P is equal to B plus C. Tax shield is 30% of, okay, and tax outflow, it will be A plus A plus D minus, yes, so this is equal to A. Okay, minus, that's it. This is G. Okay, A plus D minus Y. So now you can understand how to calculate this thing. So this one will be 42,217.22. This one is 43,000. 576.74. And your Q is 45,072.31. Okay, that's the cash outflow. All right. Now we need to calculate the present value of all these numbers. Present value is equal to, we have to get this one again. But in this case, these numbers will be different. It will be these three numbers. Okay, these numbers. And this is our number one. This one will be here 1.07, or you can say here, you can actually bring this better. And all of them are different numbers, so we cannot actually use like before. This one will be 43,576.74. The last figure will be 45,000. And we are doing this things with our present value formula. Okay. So 1, 2, 3, and the answer should be here. 114,309.31. So now you tell me which outflow you will like. That's it. Based on these two situation, which one we will prefer always? Less amounts to get out of the business. It will be this figure. It will go for purchase. That's it. Now this says here, I'll show this one very quickly in here. Consider a call option to buy one share. This is very straightforward formula here, nothing else. This will go in here. Okay. So consider a call option to buy one share that is purchased at a price of $1 with a strike price of $12. So $12 is the strike price. So they will buy it with $12. Okay. And the question is, draw a profit diagram for the option from option buyer point of view. Measure share price on the horizontal axis and the profit axis. So let's draw this diagram. So on this one, this is profit. This is share price. Look, they will strike it at $12. When the amount goes to 12, they're gonna buy it. They will buy it by $12. Okay. But they already paid $1 to get this option available to them. So they already $1 debt. So it means $13 they need to recover from selling. When the selling price goes above $13, they will start selling. That's it. Okay. I'm sorry. Selling price goes above $13, they will actually buy it because this is call option. They're gonna buy it. Okay. So when they're actually going, they can buy cheaper rate. So if the market price goes more than $13, they will start buying. That's the whole formula, nothing else in here. And here they want you to calculate the intrinsic value. For the intrinsic value of call option, if share price is $11, okay, share price $11, they're going to pay actually $12. So market price is 11, they're not going to use this power, use this opportunity. So the value is 0 actually then. Now the last one, in this case, following profit diagram for share options. They draw this one for you and you tell them what is this one, which option is call option or put option. Okay, this one is actually put option. How do you know? Because you can see this is the demand curve is in here. So the seller's point of view actually. Look at what price they are going to sell it. Okay. So this is a buy option or put option. The call option or put option. This is a put option. And the second question is, assume one option contract is 1,000 shares. What is intrinsic value of fundamental if the market price is $10? So how is the strike rate? The strike rate is $9 is the strike rate. You can see $9 is the strike rate. So they are going to actually sell it. So $9 is sell. The market rate is $10. There is no point they're going to sell it at 9. So these will have zero value, zero intrinsic value. Again, assuming one option contract 1,000 shares, what would be the net profit to the holder of one option contract if the option exercised when the price is $6? So $6 price, they're going to sell it at $9. They're going to make a good profit. Okay, but remember one thing: even they make $9, they already paid $1,000 for their options. So it looks like 9 minus 6, $3,000 they're going to make profit. Actually not. They're going to make a $2,000 profit because $1,000 is their payment fees for this derivative. That's it. Any questions do you guys have for me?
No, thank you.
Okay. Anybody else, guys?
Oh, can you like give us the brief of the exam? Like
Exam, I don't know yet.
oh, you know
I
yet?
don't know yet. I'll talk to the officer. I'll let you know. I don't know yet about exam.
Okay.
Anything else, guys?
Can I know if you received my assignment from last week? Because when I sent it to your email, it wasn't like verified, kind of thing.
So what's your name?
Jun Kai Wong.
Did you send from your email address?
Yes.
Jun Ong. Is it?
Sorry?
I got one, Jun Ong. Junwong.
Yes, that's the one. Yeah.
That's one.
All right,
Anybody
thank
else? Okay. If not, then fine. If your document doesn't open or anything issues, I'll contact. Okay, I'll close it here then. Thank you very much for coming in today. Appreciate your time and effort too.
Can you please like open the answer for this workshop?
Open the answer for what? This one?
For this workshop, yeah.
Okay, I'll do that. Anything else?
Yeah, no, thank you.
Okay. It should be fine now. Anything else I can help you with, you guys? No? Okay. I'll close it here then. Have a good evening.
Awesome. Thank you so much.
you. All right, thanks, sir.
Thank you. Bye.